Hello everyone, welcome to Betty Academy. Kindly support this channel, subscribe subscribe to this channel, hit on the notification bell, like, share, comment down below. So in this lesson we are going to learn about the information signaling effect theory. And I'll be looking at this particular points. What is signaling? I'll also use this particular diagram. I'll look at what is insider information, how to interpret insider information signaling, and the dividend signaling theory, and what is technical analysis. So to start with, what is signaling? So to start with, we'll have it. Signaling refers to the act of using insider information to initiate a trading position. It occurs when an insider releases crucial information about a company that triggers the buying or selling of its stock by people who do not ordinarily possess insider information. The actions of the insider are considered a market signal to outsiders. Yeah. So just from the term signal, yeah, it's just it's the act of using insider information to initiate a trading position. So that is what signaling means. So when you look at this particular diagram, we have the industry insiders, those who are insiders in the industry. And this particular group of people who are in the industry, they are the ones who send this particular information, the signaling, and when it reaches the investors, it will affect the position, okay, their trading position. They may either enter the market or exit the market. So that is the effect, the net effect. But when there are no signals, to the investors, it means there will be no entry or exit to the markets. So I hope we are clear up to that point. So market signaling may be obtained by tracking the shareholding and trading positions of a company's insiders. Insiders are usually senior executives or other large shareholders of the company. They may possess decision-making powers and be able to access internal information about the company. Yeah. So if these people are very senior executives, it means that they are able to access internal information about the company. So what is insider information in this case? What is this information? Insider information is a non-public fact that gives traders an advantage when trading the company's stock. Insider information is usually obtained by a person who is an employee or executive of the company. An insider may also be an outsider who is closely associated with the company. So when such persons gain knowledge about company developments that can affect its stock price, that information provides an unfair advantage over outsiders unless the information is made public. So we have insider trading is considered illegal. Yeah. So if you look at even the process of getting that information, that one tells you it is considered illegal. So insider trading exists when an officer, employee, or director of the company uses material, non-public information about the company to place trades or advise third parties to initiate trades. This is viewed as an unfair manipulation of the free market. So when you're operating in a free market, it means everyone has equal access to the information about a certain firm. So let's go to the other point. The other point that I needed to expand on is how to interpret insider information. How do you interpret it? Using insider trading activity for market signals is one of the strategies investors use in trading stocks. This is because insiders have a broader knowledge of the company, which can provide helpful insights into the value of the company's stock. For example, when an insider sells a large quantity of company stock, this can be a negative indicator for the stock's future price movement. Outside investors can read this signal and follow suit by disposing of their own shareholdings. Yeah, so it means that if an insider sells a large quantity of company stock, it means it is a negative indicator. So that one is a signal to the outside investors to follow suit. Yeah, they will also dispose their own shareholdings. And remember, no one wants to invest in a firm that they'll end up losing their investment. So conversely, when a senior executive buys the company's stock in large volumes, yeah, that person who is you are just observing his behavior. He or she may be doing that based on knowledge only held by a few people within the company. So you realize that only a few people within the company may be having that particular information or knowledge about the future of the company. So such behavior signals that the company expects positive future growth or improvement in its financials. Yeah. So that's what it implies. So investors can follow the lead given by the executive and buy the company's stock. So that's how you interpret. You follow those people who are perceived, not even perceived. Generally, they are people who have the inside information. Yeah. Like for the senior executives, those people, they are the ones who make decisions and they know the future of the company. So now let's go to the dividend signaling theory. Yeah. So the dividend signaling theory states that when a company announces an increase in its dividend payout, so financial analysts and investors read that as an indicating a positive future financial outlook for the business. While many analysts are skeptical about the dividend signaling theory, there is some evidence for its validity. Yeah. So that's what it means. Then generally, increases in dividend payouts paint a positive outlook for the company's financial and future stock price. Yeah. So every person, for any investor, if you hear a certain firm is announcing a dividend payout that is high, it means there is a positive future financial outlook for the business. So every other person would want to invest there. But a decrease in dividend payouts may indicate expected hardships for the company's financials. So, the dividend signaling theory basically suggests that companies that pay the highest dividends will be more profitable. However, some studies have concluded that dividend payouts are not necessarily related to earnings. Yeah. So if you look at the firm size effect on stock market returns, from that study, it states that it concludes that dividend payouts are not necessarily related to earnings, because there are those firms that they could be small, but still end up paying a very high dividend. So the size of the firm and all those ones, together with the dividend payouts, there are those studies. So kindly look out for those studies and look at their conclusion, and you should be able to understand what this one means. So with most large companies, increases in dividend payouts are approved by their board of directors. If they are satisfied that the company anticipates making profits in the future and that the cost is manageable, yeah. Examples of companies that have increased their dividend payouts consistently, yeah, those companies, they have increased their dividend payout, yeah, for so many years. They are known as dividend aristocrats, yeah, aristocrats. So those ones, they are those firms. So let's look at the aspect of technical analysis. So what does that one mean? In technical analysis, trading is based on identifying and interpreting the market signals provided by various technical indicators. For example, the price of a security may be analyzed using candlestick patterns to predict future price movement. So, yeah, so that one now, when you look at the way the price of those securities, the way they behave, they are able, you can analyze using that to predict future price movements. So we have bullish and bearish trend movements. They send different signals to traders. Yeah, so I think that's how even Forex works. So the pattern of a candlestick produces market signals that indicate whether to enter a long or short position in the market. So it dictates whether you are going to either sell or buy your securities in the market. So that's the end of this video. Kindly watch out for our next video and don't forget to subscribe. Until next time, goodbye.